Most investors will buy a stock and then just hold it looking to collect dividends while hoping the price goes up. But what if you could more than triple the amount of income you earn from a stock that you're holding, effectively turning it into an income machine? In this video, we show you exactly how to do that step by step. I'm Mike Bellafiore, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. We hope you agree you've found the right place to learn.
Hi, I'm Seth Freudberg, and I'm the head trader of S&B Capital's options trading desk here in Manhattan. And as many of you know, prior to the last 12 months, just about the only way that investors could earn basically any income on their portfolio was through buying equities and collecting quarterly dividends. Otherwise, you could be stuck with bond yields of literally less than a full percentage point in many cases, or if you were lucky, maybe you could get a certificate of deposit from a bank that would yield maybe close to 2%. But on the other hand, it's not like equities are much better. I mean, even today, the average yield of an S&P 500 stock is 1.74%, which is pathetic. Now, in the last 12 months, bond yields have risen pretty dramatically, and so it's now possible to buy a 6-month Treasury bill and earn over 5%, which certainly beats 2% or less like you were earning before 2022. But most investors don't know that long-term bonds are not the right place to really park your capital, because over the long haul, stocks are going to outperform bonds as the world economy continues to grow, whereas bonds basically kind of help you keep up with inflation. And just as importantly, companies that pay dividends and have a practice of increasing that dividend consistently over time have a particularly strong long-term track record. Those are known as dividend aristocrats, and they have long been known to be incredibly strong long-term investments. So what do you do if you want to own equities because you realize that they're long-term a great idea, but you also want to derive a solid income from your investments in the meantime? If you invest in equities, as I said earlier, you're likely to end up getting on average 1.74% dividend yield. Is that the best you can do to earn current income on your equities? Well, the good news of this video is that you can basically have your cake and eat it too. You can own equities and at the same time earn way more on your stocks than its dividend yield, but you have to have some knowledge of options in order to pull this off, and that is through an option strategy known as the covered call. Now, some of you may know how call options on stocks work, and for you guys, just hang in there for a few minutes. But just to make sure that everyone watching the video understands how they work, we're going to do a really, really quick review. So a call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option at any time after the call buyer buys that call option. The call buyer pays what's called a premium to the seller of the option, because the seller of the option is taking the risk that the stock will go way above the strike price of that call option, in which case the buyer can exercise his option and force the call seller to sell his shares at the call option's strike price, which is lower than they're worth. But it's also important to keep in mind that at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless, and the call seller just pockets the premium. So that's how call options work. Now, a covered call starts out with you're owning 100 shares of a stock, and then every month selling a call option on those shares that you own, usually at a strike price higher than the stock is trading at. And as we get into this upcoming example, you'll see very clearly why someone might choose to do that. Okay, so let's take a look at Exxon stock, the big oil company, which trades under the ticker symbol XOM, back about 6 months ago on August 19th, 2022. And as you can see, after reaching 105 in June, the stock pulled back in the summer initially to as low as 80 and then began to rally in mid-July, closing at 94.06 on August 19th. So let's say that at the end of the day on August 19th, you went ahead and bought 100 shares of Exxon and at the same time you went out about a month to the September monthly options expiration and you sold a call which was as far above Exxon's current price as possible, while at the same time having a value of around $1. And so the highest option that met that criterion was the 100 strike price call option, which is located about $6 above Exxon's current price. And as you can see, that option was sold for $1.26. Now, the plan is that we're going to be doing this every month for 6 months. So, for example, after the September option expires, we're going to sell an option for about $1 for the October expiration and just keep on doing that. And remember, Exxon stock pays a dividend, and in fact, over that 6-month period was paying a dividend of 91 cents per share, which on 100 shares would obviously yield $91 per quarter. Now, let's analyze exactly what's going on here with the income the trader is going to be receiving from owning 100 shares of XOM stock over the next 6 months. So first off, for September, we'll receive cash of $126 because each option represents 100 shares of stock. So you multiply the $1.26 number by 100, resulting in you receiving $126 for selling that call. And as you can see, Exxon will be paying $91 in both November and February, and that's pretty much a known, so we've added that to the schedule as well. And we know that we'll be engaging in this covered call campaign for 6 months, but only the current month's covered call income we know for sure, and that is the first one. So we've entered that onto the table, which we'll keep updating throughout this video. Okay, so let's move forward to September 16th, and as you can see, XOM closed at 93.21, and so since our call is up at 100 and it expires that day, it expires with a value of 0, obviously, because no one is going to exercise the right to buy Exxon shares at 100 when the stock's trading for 93.21, so they just go out worthless and the trader just keeps his $126. Okay, so now remember, we still own these 100 shares of Exxon, and so we can now reload, so to speak, and sell a call that expires in October about a month later. And as you can see, in this case, we sold the 105 call, and in this case, we only received $72. So now we'll go ahead and update our income table on this trade, and as you can see, we entered the $72 into the income column for October, classified as covered call income. And again, we move out to October on the day that this option expires. As you can see, XOM closed at 105.86. And remember, we sold the 105 call, so the shares we owned are sold to the owner of that call at the strike price of 105, which is a process called assignment. And your broker actually will do this for you automatically. You don't have to worry about it. Okay, so now to resume your campaign, you're going to have to buy a fresh 100 shares of XOM in order to sell the covered call for November, which, as you can see, brought in $103. And so updating our table of income, you can see that we entered the $103 from the November call. But note that the trader also gets income from the dividend that month as well in the amount of $91. And so rather than go through every month, we'll just update the chart for the full 6-month period, which just ended in mid-February. And as you can see, the total income from the shares is $677. And so to summarize, what's happened in this case, had you just bought the XOM shares and collected the dividend, you would have made $182, that being the two $91 dividends over that 6-month period. But by engaging in the covered call campaign, we nearly quadrupled the income we would have otherwise received just collecting the dividends. And so what I'd like you to take away from today's video is that stock ownership does not have to be this static situation where you receive a tiny dividend every 90 days. Instead, you can employ the covered call technique and multiply the income you receive from any dividend paying stock that you own and actually create income from stocks that don't pay any dividend at all, which happens to be 25% of all stocks. In other words, covered calls are an amazing way to expand the investment income you derive from your stocks, paying you monthly dividends on top of the stock's usually lame quarterly dividend. And in the case of stocks that don't pay any dividend at all, you basically are turning them into dividend paying stocks through the covered call income technique.
Okay, so as you just saw, you can use certain indicators to potentially make huge returns in any given year. but these signals may not happen often. What if you want to increase the consistent monthly income you can make from the markets? To find out how, click the video appearing on your screen right now to discover how you can triple your income from covered calls with a simple tweak.